Silver just hit a massive wall at $95. Everyone was watching that number. It felt like we were finally going to see triple digits. Then, everything changed in a matter of hours. The price didn't just stall, it was rejected with a level of force we haven't seen in years. You might be wondering why 95 was the breaking point. It isn't just a random number on a chart. For many big players, that was the ultimate exit sign. The sell orders were sitting there for months. When the price touched it, the floodgates opened. Now, the market is looking very different than it did last week. The momentum has completely shifted. We are seeing a pullback that feels a lot more permanent than a typical dip. Are we looking at the end of the bull run? It's a question that has a lot of people worried right now. Look at the volume coming out of the major exchanges. The institutional money is moving toward the sidelines. They aren't just taking profits. They are repositioning for a much lower entry point. Retail investors are usually the last ones to get the memo. If you're holding silver, this is a difficult moment to watch. The charts are showing a classic head and shoulders pattern. That usually doesn't end well for the price in the short term. Most people thought the industrial demand would keep it afloat. Solar panels and electronics are still using record amounts of silver, but the paper market doesn't always care about physical demand. Right now, the paper shorts are back in control. They saw the weakness at 95 and jumped on it. It's a brutal cycle we have seen before. Does this mean the silver squeeze is dead? Honestly, it depends on how deep this correction goes. Support levels are breaking one by one. $80 used to feel like a floor. Now, it looks like it might become the new ceiling. The dollar is also gaining strength at the worst possible time for precious metals. When the dollar goes up, silver usually takes a hit. It's a simple correlation that is playing out perfectly right now. Investors are flocking back to the safety of cash. That leaves silver in a very vulnerable spot. Have you checked your portfolio in the last 24 hours? The red numbers can be intimidating, but it's important to understand the mechanics of what's happening. This isn't just a random fluctuation. The market is resetting its expectations. The hype was building for too long without a real breather. $95 was the limit of that hype. Now we have to deal with the reality of a cooling market. The pullback is just getting started. We need to look at where the next real floor is. The next floor might be much lower than people think. Everyone is looking at $85 as a safety net. But those levels are already starting to wobble. When a rejection at 95 is this sharp, the momentum stays down. It's like a ball rolling down a steep hill. It doesn't just stop because we want it to. The technical indicators are flashing red across the board. The relative strength index was deep in overbought territory. Now it's crashing back toward the middle. That usually signals a long period of sideways or downward movement. Are you seeing the same thing on your charts? The moving averages are starting to cross in a way that suggests a trend reversal. This isn't just a buy the dip moment for the faint of heart. Large hedge funds are pulling their capital out of silver ETFs. They are moving that money into short-term treasuries. The yield on those is becoming more attractive as silver stays volatile. Silver doesn't pay a dividend, and that hurts during a pullback. If you aren't seeing capital appreciation, you're just holding a heavy metal. That's the cold reality of the precious metals market. It can be your best friend or your worst enemy. Right now, it's acting like an enemy to anyone who bought near the top. Did you buy in when it crossed 90? A lot of people did because of the FOMO. Fear of missing out is a powerful drug in trading. It blinds you to the signs of an exhausted rally. The rally was exhausted long before it hit 95. We saw the volume thinning out as the price climbed. That's a classic divergence that usually leads to a crash. And a crash is exactly what this is starting to look like. It isn't a slow bleed, it's a sudden drop. The mining stocks are also taking a massive hit. Usually the miners lead the metal. If the mining companies are crashing, the physical metal follows. The big silver producers are seeing their margins shrink. Energy costs for mining are still staying relatively high. If the price of silver drops too far, some mines might even pause production. You would think that would decrease supply and raise the price, but in a panic, supply doesn't matter as much as liquidity. People need cash, and they sell what they can. Silver is often the first thing to go because it's so liquid. Have you ever tried to sell physical silver during a dip? The premiums can be frustratingly high. The spot price might be dropping, but the physical cost stays up. That creates a gap that makes it hard to get out cleanly. Most investors are stuck watching their paper value disappear. The $95 mark was a psychological wall for a reason. It's just $5 shy of the triple-digit dream. That dream is now on hold for the foreseeable future. The pullback is entering its second phase. This is where the real panic starts to set in for the average holder. The second phase of a pullback is always the hardest to stomach. This is when the diamond hands start to shake. You see the initial drop and think it's just a healthy correction. Then the price hits a support level and just keeps falling. That's exactly what happened when we sliced through $88. It wasn't even a fight. The buy orders at that level were swallowed up in minutes. It's a clear sign that the bulls have left the building. Have you noticed how quiet the silver forums have become? The excitement from 2 weeks ago has turned into nervous silence. Everyone is waiting for someone else to say it's okay to buy. But the big money isn't buying yet. They are waiting for the true bottom to form. Where could that bottom actually be? Some analysts are pointing towards $75. That would be a 20% drop from the peak. In the world of commodities, a 20% drop is a bear market. Silver has a history of these violent swings. It's one of the most volatile assets you can own. One day it's the future of green energy and the ultimate hedge. The next day, it's just a speculative bubble that popped. The truth usually lies somewhere in the middle, but the market doesn't trade on the truth. It trades on fear and greed. Right now, fear is the only thing driving the price action. Look at the gold to silver ratio. It's starting to widen again after narrowing for months. When silver underperforms gold, it's a bad sign for the metals. Gold is holding up much better at its current levels. Silver is the high beta version of gold. It goes up faster, but it falls much harder. Are you prepared for another $10 drop? It's a possibility that no one wants to talk about. The $95 rejection was a blow-off top. That's a technical term for when a price spikes and then collapses. It leaves a lot of people trapped at the very top. Those people are now looking for any bounce to sell. That creates overhead resistance. Every time the price tries to go up, people sell into it. It makes a recovery very slow and painful. Look at the weekly candle on the silver chart. It's a massive red bar with a long wick at the top. That wick represents everyone who bought at 95 and got burned. They are essentially underwater on their investment. How long can they hold out before they give up? The answer to that will determine how low we go. The institutional players know this. They are watching the retail sentiment very closely. They want to see maximum pain before they step back in. This pullback is far from over. Maximum pain is a term traders use for a reason. It's the point where most people finally give up and sell. We haven't reached that point yet. There are still too many people hoping for a quick bounce back to 90. In a real crash, hope is the first thing to die. Look at the technical support levels from last year. There is a massive gap that hasn't been filled yet. Gaps in the chart have a weird way of acting like magnets. The price seems drawn to them until they are closed. Right now, that gap sits all the way down at $72. It feels impossible when we were just at 95. But silver has dropped 30% in a month before. It has done it multiple times in the last decade. Do you remember the volatility of 2020? That was a wake-up call for a lot of precious metals investors. History doesn't always repeat, but it certainly rhymes. The current rejection is mimicking those previous patterns. The relative strength index is still not in oversold territory. That means there is still plenty of room to fall. Selling pressure is actually increasing as we speak. Margin calls are starting to hit the smaller trading accounts. When you trade on margin, a $10 drop is a disaster. Brokers start liquidating positions automatically. That creates a domino effect of forced selling. It doesn't matter if you believe in the long-term value. The computer doesn't care about your silver squeeze thesis. It only cares about the collateral in your account. Have you checked your margin levels lately? If not, you might be in for a rude awakening. This forced selling is what accelerates a pullback. It's why the drop is always faster than the climb. The stairs up are slow, but the elevator down is fast. We are currently on that elevator. The doors aren't opening at 85. They didn't even slow down at 80. It's a terrifying ride for anyone who is overleveraged. Even the physical dealers are starting to lower their buyback prices. They don't want to get stuck with expensive inventory. If the shops aren't buying, who is? Right now, the answer is nobody. Everyone is standing back and watching the carnage. They want to see where the dust settles. The dust is still very much in the air. You can see it in the volatility index for silver. It's spiking to levels we haven't seen since the last major peak. High volatility usually means the trend is down. It's hard to build a base when the price is swinging $5 a day. The market needs stability before it can recover. We are nowhere near stability right now. The rejection at 95 was the starting gun for this move. The finish line is still miles away. The finish line for this drop is currently being debated by every major bank. JP Morgan is looking at an average price of $81 for the year. That's a long way down from where we were just a few weeks ago. Bank of America has much higher targets, but even they see the volatility. They know that silver can overshoot in both directions. Right now, it is overshooting to the downside. The rejection at 95 was a signal to the entire market. It told traders that the parabolic phase had hit a ceiling. When a market goes parabolic, it eventually runs out of buyers. Everyone who wanted to buy silver already did. That leaves only the sellers to dictate the next move. Have you noticed the news coming out of the Federal Reserve lately? They are staying patient with interest rates because the economy is resilient. That keeps the US dollar strong, which is a headwind for silver. A strong dollar makes silver more expensive for overseas buyers. When demand from abroad drops, the price here follows. It's a global market, and we are seeing a global cooldown. Look at the industrial side of the story for a moment. China has been implementing new export curbs on certain metals. You would think that would make silver more valuable due to scarcity, but the market is currently more focused on the macro picture. Geopolitical tensions in the Middle East provided a temporary boost. When those headlines fade, the war premium disappears from the price. That's exactly what we are witnessing right now. The safe haven buyers are moving back into gold or cash. Silver is being left behind as the riskier sibling. Is your strategy built for this kind of environment? It's easy to be a bull when the price is hitting 95. It's much harder when it's testing 80. $80 is the next big battle line on the chart. If we close below 80 on a weekly basis, the floodgates could open again. The technical analysts are calling 80 the line in the sand. If it holds, we might see a slow consolidation period. If it breaks, the next stop is $73. That represents a massive retracement from the January highs. Do you remember when silver hit 121 in January? That flash crash down to 67 happened in the blink of an eye. This current move is starting to feel like a slower version of that. It's a grinding pullback that wears out the bulls. The buy the dip crowd is getting exhausted. Every time they buy, the price settles a little lower. That's the definition of a downtrend. Honestly, the sentiment has flipped from moon to survival. People aren't asking when it hits 100 anymore. They are asking when the bleeding will stop. The bleeding usually stops when the last optimist sells. We are seeing more and more of those sales every day. The volume on the down days is higher than on the green days. That shows that the conviction is currently with the bears. $95 was the top of the mountain. The top of the mountain always looks clear in hindsight. When we were at 95, the momentum felt unstoppable. Social media was filled with predictions of 150. That's usually the first sign that the top is in. When everyone is certain the price only goes up, it's about to fall. The rejection was a reality check for the entire community. It showed that there is still a massive supply of silver waiting to be sold. Every time the price spikes, those old holders finally let go. They have been waiting for years to break even or make a small profit. That legacy supply acts like a heavy blanket on the market. It smothers any attempt at a breakout above 95. Do you think those sellers are finished? Probably not, considering how much silver is still in private vaults. The COMEX inventories have been depleted, but the private market is huge. When the price drops, those private holders get nervous too. They start to wonder if they should have sold at the peak. That regret turns into selling pressure on the next small bounce. It's a psychological trap that keeps the price suppressed. Look at the silver-backed ETFs like SLV. The outflows over the last week have been staggering. Millions of ounces are being unallocated and sold back into the market. This adds to the physical supply at exactly the wrong time. The market is being flooded while buyers are stepping back. It's a classic supply and demand imbalance. Have you ever seen a market crash while supply was increasing? It's a recipe for a very long and painful slide. The industrial side isn't helping as much as people hoped. Manufacturing in Europe is slowing down significantly. Germany is seeing a decline in industrial output for the third month. That means less silver is needed for high-end machinery and cars. The green energy story is great for the long term. But in the short term, the economy dictates the price. If we are heading for a global recession, silver will suffer. It's an industrial metal first and a monetary metal second. Gold can ignore a recession, but silver usually can't. Are you watching the copper prices as well? Copper is often a leading indicator for silver's industrial demand. Copper has been sliding for weeks, and silver is just catching up. It's a warning sign that the broader economy is cooling off. When the Dr. Copper says the economy is sick, silver feels it. The rejection at 95 was just the first symptom. Now the fever is starting to spread through the whole sector. You can see it in the way the junior miners are trading. They are being sold off like there is no tomorrow. These small companies rely on high silver prices to stay solvent. At $80, many of them are barely breaking even. If the price drops to 70, some might go bankrupt. That would eventually lead to less supply and higher prices later. But later doesn't help you if you're losing money today. The timeline for recovery is getting pushed further back. The timeline for recovery is looking longer every single day. Most investors were expecting a V-shaped bounce from 88. When that didn't happen, the mood shifted to pure frustration. Frustrated investors are the most likely to panic sell at the bottom. We are entering that grind phase where nothing seems to move up. Even the good news is being ignored by the market. Central banks are still holding their gold, but silver is being left behind. It's the forgotten stepchild of the precious metals world right now. Have you ever tried to catch a falling knife in the silver market? It's a dangerous game that usually ends in a lot of pain. The knife is still falling from that $95 rejection. There is no sign of a handle to grab onto yet. Look at the option market for silver futures. The put-to-call ratio is heavily skewed toward the downside. Traders are betting that 75 is the next logical target. When the smart money bets on lower prices, they usually win. They have the capital to move the market in their direction. They want to shake out the weak hands before the next real move. Are you one of the weak hands they are targeting? It's a question you have to answer honestly for yourself. The volatility is designed to make you question your thesis. It makes you forget why you bought silver in the first place. If you bought it for a quick flip to 100, you're in trouble. The flip has turned into a flop for most people. Now, the market is testing your conviction and your patience. Patience is the rarest commodity in the trading world. Most people want results in days, not months or years, but silver moves in massive multi-year cycles. We just finished a massive move up to 95. Now, we have to pay the price with a long move down. Look at the monthly chart for a broader perspective. The candle for this month is one of the ugliest we've ever seen. It wiped out 3 months of gains in just 2 weeks. That's a bearish engulfing pattern on a massive scale. It tells us that the sellers are completely in control. They aren't just selling, they're attacking every bid. They want to see how low they can push the price before buyers return. Where are the buyers hiding right now? They're likely sitting on a pile of cash, waiting for 68. $68 is where the last major breakout started. Old resistance often becomes new support in a healthy market. But falling from 95 to 68 is a 30% drop. Most people can't handle a 30% drawdown. It ruins their margin accounts and their mental health. The pullback is designed to be as painful as possible. It's the market's way of clearing out the excess hype. The hype at 95 was reaching a fever pitch. Now the silence is deafening as the price slides. Every day it closes lower, more people decide to exit. This is how a bottom is eventually formed. A bottom is never a clean or pretty event. It is usually born out of total exhaustion and boredom. We are moving from the panic phase into the boredom phase. That is where the price just sits in a range for months. The $95 rejection was the high watermark for this cycle. It might take a year or more to see those levels again. Does that change your long-term outlook for silver? For many, it is a reminder that silver is a marathon, not a sprint. The industrial demand for silver isn't going away. Electric vehicles still need twice as much silver as gas cars. The solar industry is still expanding across the globe, but those are slow-moving trends that take years to play out. The market for silver futures moves in seconds and minutes. The disconnect between physical reality and paper trading is huge. Right now, the paper market is winning the battle. It is forcing the price down to levels that reflect a slowing economy. Look at the commitment of traders' report for this week. The large speculators have cut their long positions by half. They are the ones who drove the price from 60 to 95. Now that they are leaving, there is no one to hold the line. Small speculators are still holding on, hoping for a miracle. But the market rarely grants miracles to those who are underwater. It usually punishes them until they finally sell. Have you ever noticed how the price jumps right after you sell? That's because the market found the last seller, which was you. We are searching for that last seller right now. Until we find them, the path of least resistance is down. The $80 level is being tested as we speak. If it fails, 75 is the next logical stop. The rejection at 95 was a clear warning to everyone. It said that the price had gotten ahead of the fundamentals. Now, the fundamentals have to catch up to the price. That process is slow and often very frustrating. Are you prepared to wait out a 6-month correction? Many people aren't, and they will lose money because of it. The winners in silver are always the ones with the most patience. They buy when everyone else is terrified and silent. They sell when everyone else is screaming about triple digits. $95 was the time to be a seller. $80 is still a no man's land for many traders. We need to see a base form before we can talk about a recovery. A base looks like a flat line on the chart for several weeks. We haven't seen a flat line yet. We've only seen a cliff. Don't try to be a hero and buy the first big drop. Let the market prove that it has stopped falling first. The biggest pullback in years is just getting its second wind. It's a tough environment for any investor to navigate. Keep your eyes on the $80 closing price today. It will tell you everything you need to know about next week. The story of silver at 95 is officially over. The story of the great pullback is just beginning.